Good afternoon, everyone. This is Sam McGrasty with Brady Ware Dealership Advisors. Excited to for another webinar this month. And this month we have Kevin Nill from Haig Partners, who's going to talk about some of the M&A activity, the buy-sell activity that's been going on in the dealerships and the retail market. So we're really excited to hear him. And with that, I'll turn it over to Kevin.
Sam, thank you very much, and your whole team at Brady Ware really appreciate the opportunity to present to your clients and share a little bit about what we've been seeing and experiencing in the auto retail market as well as the buy-sell market over the last 12 to 15 months. I hope everybody can see the presentation in front of you, and I'll go through it, and then at the end we'll probably collect some questions either to myself directly or to Sam, and we'll follow back up with you independently for that. But thank you for your time today. As everyone has experienced, the last year plus has been quite a roller coaster, not only personally but professionally as well, given what the industry went through in March and April with the shutdown, and a lot of concern about how auto retail would survive during that episode. And then who would have thought just a few months later, as business began to return, that the sector would just experience phenomenal growth and just continue that performance even past all of the post-pandemic, pent-up demand and things of that nature. Sales, volume, activity still stayed very strong, and gross profits were exceptional given some of the inventory challenges. So we were excited to see dealerships just have exceptional performance in 2020, and many dealers that we've spoken with over the last number of months share with us that they had record performance in 2020, and certainly none of us would have expected that back in March or April. So I'd like to take the next few minutes. We'll show you some information on what we've seen on macro trends around the industry and what we're seeing on the buy-sell marketplace as well, and hopefully can provide you some insight as you're managing your business. Next couple of slides are going to address and illustrate to you some of the macroeconomic indicators that we're seeing out there, and it's a bit of a mixed message. For the most part, I would say that the indicators are very, very positive. On this slide, you can see unemployment has certainly come down materially since the shutdown, and all indications are that will continue, which is very positive. And then consumer confidence, which was very much impacted in the spring of last year, has begun to rebound, and we've got some preliminary results we show in March there on the far right there that indicate that those numbers are almost approaching pre-pandemic levels, which is exciting to see, because this particularly consumer sentiment is a direct correlation to car sales, and so we follow this very much closely. Additional indicators that are very positive: obviously inflation has stayed very low, and the Fed has been very accommodating with interest rates. Every indicator seems to reflect that those rates will stay down for the foreseeable future. And obviously that impacts dealers from the standpoint of lower floor plan interest rates, lower real estate costs, and then also from the consumer perspective, as your consumers come into your dealership, they can buy vehicles with lower cost of borrowing, so that makes it a more attractive proposition for them. A couple of the flip side areas here that we're obviously all experiencing a little bit. We've seen gas come up fairly significantly over the last few months, and then the whole concept of, are people going to drive more, or are they going to drive less? And then I think in different markets, it's a different perspective. In some of the major metro markets where use of public transportation is more prevalent, you might see some people migrating into cars and be much more positive. Conversely, you obviously have now a number of individuals who can work from home, and that may end up becoming more of a permanent situation. So I would say the jury's still out on how the overall miles driven impact will play itself out, but clearly over the last number of months, as people stayed home, miles driven dropped dramatically, and that impacts cars wearing out. It impacts service business, things of that nature. Some of the good news that I'm sure every dealer on the webinar has experienced are that gross profits have increased materially. Largely a function of just inventory, supply and demand. This is a chart that shows the public companies and how their new car front-end gross has performed, and you can see here 24% from 2019 to 2020, over $500 in front end gross was experienced because of the fact that they had fewer cars and they're expecting to get gross from them. I was just speaking with a large dealer in the Midwest last week. They have 6 or 7 stores, and they've just implemented a full MSRP policy across all of their dealerships, particularly now as the chip shortage continues, that they're, when they have vehicles, they're going to sell them at full MSRP. So we don't anticipate that to subside, and we'll talk a little bit more about that in some coming slides. Additionally, used cars on the next slide here experienced an equally robust increase in gross profit performance. Clearly a big ebb and flow coming out of the lockdown. There was a big drop in used car pricing, but then it rebounded very significantly, and it's been a very hot market since. And we expect that that will continue and probably be even more challenging in the coming months as dealers struggle for new car product, as the factories are challenged to get it to you. We are hearing and seeing already that dealers are getting very, very aggressive in acquiring used cars, and the market for that has become hyper competitive. So it'll be interesting to see how grosses do from that perspective. But so far in 2020, obviously a very nice, again, tailwind. F&I remains a very nice trend up. It did not stop that trend in 2020, as you can see here. These are public numbers. Again, this does not, they don't have offshore income or anything like that. So this is straight F&I income. And you can see they continue to do very well. You've got average transaction prices are going up. You've got better training and better participation in selling product. And so you're continuing to see this be a major profit center for the dealerships. And I suspect your dealerships are seeing the same results. One of the areas that was a little bit of, not a surprise per se, disappointing of course, but not unexpected with the pandemic, was the impact in fixed operations. Consistently, as you can see here across many of the last few years, it's been a nice steady growth opportunity for all dealers. And then in 2020, when you had the shutdown, obviously we lost a lot of days in the lanes, in the service area, and that can't be made up. A lot of buyers, obviously, if they can't buy a car for a week or 2 weeks, weather, whatever, they come back and you can still recapture most of that. But given that most dealership service areas are at max capacity, when you lose that time, you really can't make it back up. And so we saw that in 2020. But the last bar on this chart shows just specifically the fourth quarter and a nice rebound there. So as we've spoken to dealers, we are hearing pretty consistently now that their fixed operations are back to previous levels, and as this chart would indicate, are now back in a growth mode again. So that's very encouraging for everyone involved. This slide shows a waterfall of operating expenses for the dealership, and not unexpected. I suspect it's similar to the dealers on the webinar, what they've seen. But we've seen a nice decline in overall expenses in 2020 versus 19. The number of dealers we've spoken with here on the advertising component, they say they've pulled it back almost completely. Why advertise when they don't have product and the product they have is moving off at full sticker? So they've pulled that back for the foreseeable future. Obviously, floor plan has gone from a net expense to a net profit provider now as units move quickly, rates have adjusted. So we expect to see that again for 2021. And then other SG&A also was pulled down. The net result on the next 2 slides are overall earnings for the average private dealership, and these are NADA results. I want to point out there's a bullet there at the bottom. We have adjusted these, and on the next slide it'll show it again by month. We began to see in the late fourth quarter and particularly in December some significant earnings results that were being reported on these NADA numbers. And as we talked to accountants, we talked to dealers, and bankers, we began to hear that there was a rising percentage of dealers who are receiving their forgiveness for PPP in November and December. So while a vast majority of dealers, we believe, will get that in 2021, we did think that there was beginning to see a bit of a spike in that, and particularly in December, the earnings results that were reported by NADA were through the roof, so to speak. So what we have done is we looked at what average other income on a typical basis would be, and what we were seeing on these results. We somewhat made some informed adjustments and reduced it by about $200,000 off of what was being reported, to just provide for an estimate of a PPP that might have been hitting the statements for some of the dealers that had received forgiveness. So these numbers are less than 200,000. And on the next page, you'll see the results at the end of the year. There would have been a very high number on the far right with December if we had not pulled that December number, or that 200,000 rather number out of December results. It would have been over $300,000, which would have been the high water mark for the year. But you can see on this chart just great progress in recapturing all of the lost earnings from that March-April time frame, and then ratcheted it right back up, and by August had made it all back up and then some, and then it was, so to speak, gravy through the rest of the year as dealers were ahead of last year's pace. So just again, back to my opening comments, just a fantastic year, one that I don't think many of us saw coming in April and May. We were wondering what was going to happen, but it just illustrates the resiliency and the strength of the auto retail model and the dealerships. Let's shift over to the buy-sell market, because it too was equally impacted by what transpired in 2020. When we came into the pandemic and the lockdown, we saw within our practice business M&A deals come to a halt. We had a number of transactions that were either postponed or broke in that March, April, May timeframe, as there was just so much uncertainty about what would happen. But as the business began to rebound, dealers began to perform better again, those transactions were put back together. And in some cases, later in the year, when we sold some deals that were postponed, they were repriced higher later in the year, because the underlying performance of the dealerships just continued to do very, very well. But this chart reflects for you, what the overall dealership acquisition pace has been over the last number of years. And you can see in 2020, despite what took place in the spring, overall for the year, we exceeded the 2019 results, which is hard to believe, but really was driven by the fourth quarter, which is what's shown down below. Now, the blue are private dealer acquisitions, and the red are public dealer acquisitions. And you can see that in the fourth quarter of 2020, a very significant number of transactions, well over, a third of the deals were done there in the fourth quarter alone. The next page shows a little bit out from the public company perspective how their spending has been. They're sometimes a barometer for how the market is going, because private dealers will follow suit if they're seeing a lot of activity. And you can see in 2020 a massive acquisition pace for the publics, largely driven by two of them, Asbury and Lithia particularly. Asbury had a very large acquisition. Lithia has been on a buying spree for the last number of years, and has been very, very open about their goal to continue to grow exponentially over the next 5 years. So now we're beginning to see, and we have done transactions with several of the other public groups as well now that are feeling that the pressure, I guess, from Asbury and Lithia in their growth, and they're now following suit. So it's been very positive from that perspective. As a result, the market is rewarding these growth stocks and these public companies. This illustrates for you how the stock performance for auto retail is done year to date through the first quarter, and then on a rolling 15 months from January of last year, and then on a 3-year basis. I will caveat the used retailers, that component, that's CarMax and Carvana, if you're wondering what was incorporated in that number. But you can see some very, very nice performance year to date. The new car dealers are vastly outperforming the S&P 500, as well as over the last 15 months, and then particularly on the 3-year basis. Auto retail, again, driven by these growth stories like Lithia, has definitely been rewarded in the marketplace. One of the questions that we're asking ourselves, and as we're talking to dealers, accountants, bankers, attorneys, it will be the impact from the Biden administration's proposed tax change. Capital gains is one of the core areas that the administration is targeting, And while we're all watching that closely, not sure, with Congress being evenly split, whether there'll be some accommodations or compromises there. But if capital gains go up to what the Biden administration proposes, it's a very material change and a significant impact for sellers. So this is something that will be watched closely and is candidly probably driving a lot of activity and behavior in 2021, as those sellers who are either firmly prepared to sell their businesses this year, or ones that have been thinking about it and giving it consideration, have decided to accelerate that process to take advantage of the capital gains rates in 2021 versus the potential for out years. This brings us into some conversation around valuations. It's been an interesting period of time to try and work between buyers and sellers on how to value dealerships. There's been such volatility in earnings, from significant losses in the spring to record profits through the rest of the year. Questions on how buyers are going to factor that into their methodologies for coming up with a value, and what are the expectations of sellers. Then you've got some other components of that around PPP, which is clearly a one-time situation, will be adjusted. But you've got inventory shortages, you've got vendor concessions in 2020, and that was a clear benefit from an expense standpoint, furloughs, interest rates, et cetera. Those are all factors that are going into the overall underlying earnings of a dealership, and in the analysis for what's my core, as a buyer, what's my core cash flow stream going forward. So in addition, how will lenders work and identify what amount of cash flow they're going to lend off of? All of our conversations with lenders so far have been very, very positive. They continue to be in a high growth mode, looking for transactions. I think they've been impacted by the lower floor plan outstandings because of the lack of inventory. So they're looking for good deals to boost their balances on their balance sheet. And so we expect that to be a positive so far for this year. Real estate values has been interesting for us. When we first started to get some appraisals after the lockdown began to ease, we started to see some arbitrary adjustments in real estate pricing from appraisers, where they just were taking 5 to 10% quote market adjustments off of the real estate. Similar to what we saw back in 2008 when we had the economic distress. But then as we began to see dealerships rebound, performance go up, sellers pushing back, advisors pushing back on and showing that the auto retail sector has experienced no degradation, we started to see that getting pulled out, and we're seeing appraised values either at or higher than they were before. So what could have been a bit of a pullback on the real estate side, once again, because of how positively the dealerships have performed and the resilience of that industry, I think it's being rewarded by some nice stable and in some markets increasing real estate values, which is fantastic to see. These are some valuation thoughts that we put together relative, again, to what we're expecting and how buyers are looking at deals. And you'll notice my first bullet here, inventory shortages should continue for most of 2021. We see that as both a positive, and you'll see it down also in the negative category. On one hand, many dealers are experiencing fantastic gross profits because there's limited inventory. On the next bullet as well, manufacturers appear to be recognizing that if they can match up production with demand, everybody wins. Manufacturers win, retailers win, suppliers win, and you don't have to subsidize the units. You don't have some significant subvention dollars in place. So that's very much a positive. Just flipping over just within that category, the challenge, the reason why it might be a negative in 2021 is just merely the fact that there may not even be, despite the fact you can get good gross profit, you still may not get enough product to even cover the bare minimum of what you need from a consumer demand perspective. So we're already hearing a number of dealers talking about having to really push hard on the used car side to make up for the lack of inventory that they've got right now. We'll see how the whole chip thing works itself out. But back into the positives again, interest rates, we everything we're seeing and hearing, it's late 22, 23 event before rates may rise again. Again, as I showed you in that earlier waterfall slide, dealers have been very aggressive from a cost-cutting perspective. One of the benefits that comes out of economic uncertainty is a greater focus on expenses. We all tend to get a little more complacent and indifferent around expenses when things are very, very good. And this is giving dealers a chance to relook with their finance professionals and advisors at their expense loads and make appropriate adjustments. Used cars, as I've shared, used cars, F&I, fixed, again, becoming much more of a focal point for dealers, which generates strong profitability for the dealerships. Technology, and really we saw a continued lift in that, and that's what's driving a lot of this consolidation and scale opportunities, because dealers are seeing the advantages that technology brings to them, and those with large platforms of stores really have the capital and the not only the financial capital, but the intellectual capital to be highly innovative and shift their business model to how customers are going to want to transact business on a go-forward basis. So it's definitely, once again, becoming a key focal point for improvements and consolidation efforts in this space. We're seeing a number of buyers come into the market, not only your traditional buyers, the public companies and your privates, but family office money, private equity money, once again, is looking at the space. I think they probably took a bit of a pause. In 2018, 2019, there wasn't that much interest because the industry had kind of flatlined from a top line revenue perspective, and in fact, it had come back a little bit. But coming out once again out of the pandemic, I think outside investors have seen how successful the business model is, even in downtimes rather, and so they're much more intrigued about acquiring dealerships. And then, as I mentioned, consolidation is continuing, and it's creating competition, which is good for sellers. So in many cases, we're getting a number of bids for the business, and that's good for creating value for sellers. On the negative side, again, I won't belabor the inventory situation, but where will the economic situation land itself? Some markets have been more impacted than others. You think of the New York Cities of the world, the Chicagos of the world that have been impacted because of the shutdowns. Where will employment settle out at? Things of that nature. The miles driven that we talked about earlier, how will that impact the service lanes for the foreseeable future? Many of the expense reductions are temporary in nature, so we expect some of those will revert back to prior levels. And then you've got the long-term threats about EVs from the standpoint of there's still the question mark around how that will impact service and the amount of capital that dealerships have to deploy to put all the charging stations in place and have all the equipment to work on these EVs in their service departments. And then you've got competitors like Tesla and Rivian. Tesla, I believe, is could arguably be the #1 luxury brand in the state of California, as an example. And then taxes, as we talked about, that could definitely be a threat in out years for buyers. And obviously, the more taxes, the less after-tax cash flow they have to justify that investment. This chart here shares where we see multiples. We just released this a couple of weeks ago in our fourth quarter Haig report. And these are average multiples that a buyer would be applying against the cash flow streams for their specific franchises. And this is based on a lot of, obviously, transactions that we're seen in our practice, as well as significant conversations with attorneys, CPAs, bankers, buyers in the marketplace on how transactions are trading. We definitely saw a pullback in multiples earlier in 2020 with a nice gradual steady return to prior levels. And in this case, we specifically called out Toyota. We've sold 5 or 6 Toyota stores here, significant large Toyota stores in the last 2 months, and we've seen very significant demand for those franchises. That manufacturer dealer relationship is probably the best in the industry. So buyers like Toyota from that perspective. Strong throughput of the stores, very consistent profitability, not over dealered in most marketplaces. So it's a great brand, and continue. Other brands similar to it, Honda, Subaru, et cetera, are still very much in demand, but we've definitely seen Toyota take a little bit of an uptick here in the fourth quarter, so we called that out. Of course, these are averages, and people always ask, well, what about my specific situation? Multiples can be affected by a number of factors, and on this next page, we've just tried to summarize a few of them for you that can either push the multiple up or down, depending. Ironically enough, if a store is an underperforming store and has a lot of room for opportunity for improvement, you'll tend to see that multiple trade higher because there's just so much upside there. Conversely, a very, very effective, efficient dealership, that's, well above the industry average from a net to sales perspective. Sometimes buyers will actually push the multiple down just a little bit because they feel like there's more risk that the business will revert to a weaker performance than that they can improve upon it. So that's one factor. Obviously, metro versus rural markets drive multiples. High growth markets versus more stagnant markets. Texas, Florida, the Southeast, those are very attractive markets. A lot of population growth, very business friendly. The next bullet as well there, low taxes apply to a number of those states. So they're business friendly, they've got growth, they don't have state income taxes. Those are all very much positives that drive higher multiples. And conversely, obviously in markets where it's much more difficult to do business, or you may have unions, you've got high tax situations. It's not that there's still not really good demand for dealerships in that market, but you may not have as many outside market dealers looking to get into that area, and it could compress multiples. Real estate's a big factor. Are the facilities imaged? Are they in the right area of town? Is there going to be significant capex that will be required from a buyer by the OEM when they go for approval on the franchise? That definitely has an impact. And then geography. When we say geography well suited to a franchise, what we mean there is a truck dealer, a Ford, Chrysler, Dodge, Jeep, Ram, Chevrolet in Texas obviously is going to be much more in demand than a similar type franchise, say in the New England market or in the Northeast, where sometimes, particularly in bigger cities, you can't drive or don't want to drive the big Suburban or the big F-150, things of that nature, versus in Texas where everybody wants to drive a truck. So these are some of the factors that drive those multiples up or down. So in summary, where do we see that from a blue sky value perspective? So we apply that average multiple against the earnings performance. And again, we've adjusted this for the PPP. And you can see despite that, values for the underlying average dealership were still up materially and over 20% from the prior year. So very positive, despite all of the negative challenges with COVID, the lockdown, travel restrictions, problems, just all the things that we've been experiencing. Dealerships have actually risen in value, which is just phenomenal. And every dealer on the phone should be just congratulated for how they've managed their business through a period of time none of us have never expected to encounter. So congratulations on that. So with that, Sam, I will turn it back over to you. But as I mentioned at the beginning, I'm sure there'll be some questions that may come out of the presentation, and I would welcome the chance to speak via email, via phone, whatever's easier for dealers. If they've got some questions, if they'd like to have a confidential conversation about their business, we would be happy to do that as well. My contact information is here on the slide.
Thank you, Kevin. A lot of great information there, as you can see. That was just, it's amazing when you, especially that last slide, you go through a pandemic and you see the multiples rise at that 20% level. That's just very impressive. So great information. I really appreciate you taking your time and doing this for us, Kevin. And again, if you do have questions, Kevin's slide has his contact information, or reach out to myself and we'll get you answers back or get you connected as well. So again, thanks everyone for joining, and please join us next month for our next webinar series. And we'll see you next month. Take care, everyone. Bye.